What if I told you that one of the best and most dominant companies in the entire stock market is currently on sale? Zoetis, the undisputed leader in animal health, is down 17% over the past year. Like many healthcare stocks, it's been hit hard. But is this a sign of trouble, or is it an opportunity we, as long-term investors, have been waiting for? The stock has rarely looked this cheap, with a forward P of around 21, a number we haven't seen in a very long time for a company of this quality. In this video, we are going to do a deep dive into Zoetis. We'll break down its business, powerful competitive advantage, its current financials and its valuation to answer the ultimate question. Is now the time to invest in ZTS and make serious money over the long haul? Let's find out. So, what exactly does Zoetis do? They are the global leader in animal health, developing and manufacturing medicine, vaccines, and diagnostic products for both livestock and our beloved pets. Think of them as the Pfizer or Johnson & Johnson, but for animals. This isn't a business that's easily disrupted. Zoetis' competitive advantage or moat is massive. They have a huge portfolio of trusted brands like Apoquel and Simparica Trio, a global distribution network that's second to none, and a massive R&D budget that consistently pumps out innovative new products. While they do have competitors like Elanco and Merck Animal Health, Zoetis' scale and deep relationships with veterinarians and farmers create a powerful and lasting competitive edge that's incredibly difficult to replicate. Zoetis is a $66 billion company trading at an EV to EBITDA of 18 and a forward P of 21.7. Their margins are incredible, around gross margins around 70% and net margins of 27% last year. Their returns are incredible. They have a pretty solid balance sheet, returns on equity of almost 52%, return on invested capital last year was 25% and the average of the last 5 years was close to 20%. To evaluate the quality, the fundamentals of this company, will follow our money journey checklist to evaluate how good is this company. In terms of revenue, they've been growing around 8.2%. The revenues, earnings per share a little bit higher, which is very stable, not a high growing company, but still very good growth. The market potential, industry growth prospect in the future are expecting to grow around 6%. So for this company, which usually grows above the industry average, is expected to compound earnings per share around 8% in the future, which is very good. If you see growth around free cash flow per share growing 8% per year, I will be very happy. So bear in mind, this is a very stable company. They have high recurring revenues. If you see the quality of the revenues, I would say there are a lot of recurring revenue, but still some part is consumer based. You should look into the revenue graph, for example, growing every year. Free cash flow and net income growing as well, very profitable, no stock-based compensation, which is very good news. There are a lot of recurring revenue in this company, and its predictability has been very good, and I expect it will continue in the future. They have been developing a lot of product. They invest heavily in research and development, and the research and development have been very effective. Just have to look into the returns on invested capital above 20%, returns on equity above 50%. This is a very high quality company, and they are willing to invest in R&D and new products, and they have been very profitable with this investment. In terms of margins, very good. In the last 8 years, they have been gross margins of 70%, and they are going higher. If you look at their gross margins, 69.5, 17.6, for example. Net income margins have been growing as well. So their margins are very, very good. So it's all check mark. In terms of maintaining profit margin, which is very important, their gross margins are slightly growing a little bit each year, earnings per share as well, so it's a yes, which is very important. And their margins compare with competition, they have better margins, so it is a better company, a leader in this market. They are now starting to have some competition, but their margins are growing, they are a leader, and the relationship they have with the farmers, the veterinarians, are very good. So it is a wide moat company. In terms of pricing power, the company can increase their prices. Of course, they have a lot of pricing power, which is an attribute to a company that is very important, and they have it. They can increase the price on their drugs 5%, 10%. People with pets or the farmers will continue to buy it because you'll buy everything for your pet. The relationship with your pets are increasing. There are more people paying for pets. The farmers, there are a lot of demand, and it will be in the future with people eating protein, and the world population is growing, so there will be more demand for the farmers as well. In terms of debt, they are not net positive in their debt, but they could pay with 1 year of free cash flow, 1.5 years, all their debt in it. So they have better debt, especially in an industry that is highly leveraged, because they have to invest a lot in infrastructure, factories, automated lines, for example, for their products, and their balance sheet is incredibly good for this industry. In terms of rates of return on invested capital, 25% last year is very, very high. In terms of management, they have one of the best management teams in the industry, and even in the US market, for example. Their management is extraordinary. Their culture, reputation, and labor relations are extraordinary as well. Moat and competitive advantage. They have plenty of moats. They have the R&D, intangible assets, their brands, but their talent is very good as well. So they have a wide moat, and I do not believe if you have plenty of money and try to invest in this industry that you could disrupt Zoetis, or even a little bit gaining some market share. It's very difficult to compete with Zoetis. Free cash flow per share has been growth around 12.3%, revenues growing around 8%, but free cash flow per share growing at 12%. So they are growing organically, and their margins as well. And they have been returning capital to the shareholders. They pay a 1.3% dividend, and they do some buybacks. I expect them to increase their buybacks since they are trading at the lowest forward P, for example, in the last 10 years. So with this, I have a quality score of 83. As from what I have analyzing companies, above 6 is a very good company, but above 8 is an extremely very good company. And Zoetis is an incredible business model. So is this a question? Is it cheap? Forward P is not cheap, but we have to do our valuation. We'll do next. Is it a good business? Yes. Who's running it? Christine Peck is the CEO, and their management team is very good. What did I miss? What is the bear case for Zoetis? Growth slowing, maybe they could stable facing competition. There is competition coming, and their growth slowing. Maybe that's the bear case. In terms of source of returns, of course, it is a company will grow. We will have revenues and earnings grow. P expansions. Maybe we are trading at the lowest forward P that we have seen in the history of Zoetis. They could expand, but right now 21, 22, it's already a high P. So maybe it's they deserve this P. I do believe, but we can have an expansion, but I will not take it for granted. In terms of buybacks and dividends, they are doing buybacks and dividends to increase shareholder value. So this is a very good company, but is this cheap, fair value, or is this company overvalued? Let's do our discounted cash flow analysis. So it is a US company. I would say it's a safe investment. Their revenues are very recurring, very predictable business model. They have been doing buybacks, dividends, so I'm expecting them to grow around 6%. They are expected not to grow very much this year, but resume growth in 2026 around 6%. The average has been 8% per year, so I will assume 6%, which is the industry average. Historically, Zoetis has been growing faster than this industry, the healthcare, animal healthcare, which has been growing around 6%. But I do believe, trying to be conservative, they can grow around 6% in the next 5 years. Future P, I think they deserve around this P, 22, 20 P for my base case. And they have an expanding margin. Right now, net margins are around 27%. They are expecting to increase their margins. So I'm expecting 28% for my base case. Of course, I do a bull case, a more optimistic case, a bear case as well. And with these assumptions, I came with an intrinsic value of $122. Right now, the stock is trading at 148. It's very difficult to find a company like Zoetis trading cheaply. It's not close to my fair value. My fair value has already some margins of safety, so if you want a return of 9%, for example, or 8%, this might be your fair value. I do believe Zoetis fair value will be around $150 right now. If you look to the graph of the stock price, they've been going nowhere in the last 5 years. So to wrap it all up, Zoetis is an absolutely incredible, extremely well managed and shareholder friendly company. For years, the biggest problem for investors like us was its sky-high valuation, but with the recent pullback, we are finally seeing a valuation that looks fair, something we haven't seen since it was spun off from Pfizer. The fundamentals remain strong, the growth drivers are intact, and its competitive moat is as wide as ever. While no investment is without risk, the current price offers a compelling entry point for truly world-class business. This could be one of those opportunities you look back in 5 or 10 years and wish you had taken. But what do you think? Is Zoetis a buy at these levels, or are you still staying away? Let me know your thoughts in the comments below, and if you got any value out of this video, make sure to hit that like button and subscribe. See you in the next one. This video is for informational purpose only and should not be considered financial advice. Always conduct your own research and consult with a qualified financial advisor before making any investment decision.